Hey investor friends, I'm Michelle Markey and today I'm going to talk about my key takeaways of famous value investor Li Lu's lecture called The Prospect of Value Investing in China that he gave at Peking University in October 2015. And you can find this lecture by going to Himalaya Capital, the fund that Li Lu runs, its website called himcap.com, and then to its publications page, and then downloading the English translation PDF. And I find this to be a very useful lecture because it reinforces a lot of the teachings of Warren Buffett and Charlie Munger, and it's no coincidence because Li Lu met Warren Buffett in a lecture that Buffett gave at Columbia University a long time ago, and then he became very close friends with Charlie Munger, so much so that Charlie Munger is also invested in Himalaya Capital. So it's amazing that Li Lu has shared a lot of value investing knowledge through this lecture, and I'm thankful to be able to have read through it and share these insights with you. And another point I wanted to make was how at the 2021 Berkshire Hathaway annual meeting, Warren Buffett brought up a couple of lists. One in how 30 years ago, the companies that were the top 20 largest companies by market cap are no longer the same ones in the top 20 as of March 2021. And although most of them are American companies, there's also a few Chinese companies that we see on the list now. And even though some of them like Tencent and Alibaba have lost some market share lately, if Li Lu's observations are correct based on how Charlie Munger, Monish Pabrai, and Phil Town have bought into Alibaba, it seems like the prospect of value investing in China is very much alive, and maybe in the next 30 years we'll see more Chinese companies on this list as value investors seek out investment in China and other emerging markets where there's plenty of opportunity. And if you're also someone who seeks wisdom and wants to be the best investor you can be, I'd love if you could please like and subscribe to my video and YouTube channel, because that's what I'm all about, is to help you and myself do well as value investors who are following in the footsteps of Warren Buffett and Charlie Munger. Thanks. Since this lecture was geared towards students who were aspiring financial professionals, Li Lu focuses on four main topics that include: number one, the basic characteristics and fundamental ethics of the financial service and asset management profession. Number two, we need to know which financial assets can achieve sustained, effective, safe, and reliable growth and wealth. Three, the preparation to provide value-added services to clients to grow their wealth is the right way and main path for investment. And four, investment theories that may or may not apply to China's trajectory. So let's get into it. Li Lu said that most consumers don't have a way of judging whether services and asset management are superior or not. And this is unlike in other industries where people can experience the quality of a car, hotel, or restaurant. And since most people can't distinguish good from bad products and services, most investment theories are subject to the axiom, where you sit determines how you think and what you say. And Li Lu also goes on to say that the investment track record of people is hard to discern. Even after 5 or 10 years of having a track record, it could take longer. And even though a lot of people are drawn to the investment management profession because of the high compensation, he has a few principles in trying to guide these students of how to think about going into this profession. Li Lu asserts that even though the overall average compensation is high in the asset management industry, it's not necessarily tied to the outcomes of wealth of clients, in that you get paid regardless of whether you made money for your client or not. So he questions whether some of these professionals really deserve that high compensation, because this industry is filled with half-truths and fallacies, and it lacks clear standards. Li Lu astutely observes that many people will substitute their own interests for that of the clients, and he said that you should treat every penny that's entrusted to you as though it were the hard-earned savings of your parents over the course of their lifetimes. And he said that having a sense of fiduciary duty is either part of someone's DNA or it's not. And someone who doesn't have a sense of fiduciary duty will destroy other people's wealth. So he makes two key points when it comes to this, in that the first one is make it your ethical obligation to seek truth and wisdom and consciously refrain from allowing where you sit to determine how you think. And second, develop a sense of fiduciary duty. And he repeats this a few times later in the lecture. Since the Western economy matured the earliest and is the largest and has data over the last 200 years, Li Lu looked at various asset performances from 1801 through 2014, and he borrowed data from Professor Siegel of Wharton and the charts of the returns of U.S. stocks, which was about 6.7%, and that's against a backdrop of U.S. GDP growth of 3.6%, and we can see that the returns for bonds and gold and the U.S. dollar have trailed significantly compared to that of U.S. stocks. So much so that if you had invested $1 in stocks in 1802, that would have returned a little over $1 million to date. And this compares to the value of the US dollar, which $1 in 1802 became a nickel. So it lost 95% of its value in 200 years. That's pretty incredible how Li Lu observes that most people tend to think that stocks are riskier, so that maybe having money in cash is safer. But it turns out that your money is not so safe if you just have it in cash because of the effects of inflation. So he said the overall average inflation was 1.4% over that 200-year period. So we can see because of the inflation rate, which was largely because of investment and GDP growth, that the value of the US dollar declined significantly over that period of time. Being that stocks represent the large-scale companies in an economy, the growth in gross domestic product, or GDP, can be somewhat measured by the growth in revenues for these companies. And Li Lu said that since revenue tends to grow faster than fixed costs, that then revenues will grow and net profit will grow even faster than the growth rate of revenues. So if we have a GDP growing at about 3 to 4% per year, we can expect to see revenues growing at 4 to 5% per year. And then this means ultimately that net profit and cash flows could be growing at about 6 to 7% per year. And we see this play out in the average historical price to earnings ratio of stocks of 15. And if we invert that, so we divide 1 by 15, we get the rate of return of 6.7% that is supposed to be the historical norm. And then Li Lu gives us a little history lesson in describing the evolution of civilization over the last 16,000 years. And he describes how basic economic activity has been based on the capture and expenditure of energy, which is somewhat correlated to the idea of GDP. And he said that in Civilization 1.0, that was the era of hunter-gatherers, followed by Civilization 2.0, the era of agricultural revolution, and then the era of Civilization 3.0, which was the modernization of science and technology. Investing and the growth of wealth was enabled by sustained cumulative GDP growth in a free market economy together with science and technology. And when this emerged, this was allowed to thrive since about the 1750s. And he also goes on to cite Adam Smith and David Ricardo in that the division of labor allowed two individuals or economies to participate in free trade, and they were able to create more value than if they tried producing goods and services on their own. And this led to the concept of 1 + 1 is greater than 2. And then modern science and technology acted as an accelerant to the value creation process, where ideas rather than only commodities and services were allowed to be exchanged. So I like how Li Lu put this in that being able to have knowledge created more value, so much so that being able to exchange ideas led to having a 1 + 1 is greater than 4 outcome. So this was a bigger improvement upon the idea of free trade, and this is the power of modern science and technology. In essence, the modern free market economic system unleashes human potential, which leads to sustained economic development, which manifests in sustained GDP growth. And then Li Lu goes on to say that in order to grow the economy, the money supply has to increase in order to fund investments, and this eventually leads to finished goods and services. But in the meantime, with the time lag between when we first invest and then get finished products and services, that is what's considered inflation, and that's what's caused the loss of purchasing power of the dollar, whereas stocks will tend to go up in value over time. On to topic 3, Li Lu explores the question of what is the right way and main path to invest. and how does one become a great investor. So he explores time periods over the last 200 years of the US stock market's performance and found that the average rate of return was 6.6%. And if he broke this into smaller time periods, some of them, like the 66 years between 1946 to 2012, also held true to the long-term average, and it was about 6.4%. But in any given stretch of between 10 to 20 years, we could see rates of return be as low as around 0% to as high as maybe 13.6% per year on average. And even though we might get lucky in certain time periods, there could also be time periods where we're not so lucky. So we should be able to discern if our rates of return was due to our good fortune or ability, and depending on which it is, that's important to know about ourselves, of whether we just got lucky or we actually had skill in generating these returns during different time periods, because you could conceivably not lift a finger and get 14% returns easily, like we've experienced since the 2020 low, and that's even been higher than 14%. But in any event, it's important to ask ourselves, if we just want to have the long-term stock market average, then we can totally invest in a stock market index fund. But if not, if we want to have a more reliable, sustainable way to invest, that's what Li Lu goes into more details about, as to how we can invest for the long term and generate better than average returns. Li Lu found that very few can sustain an outstanding performance record over the long haul against the stock market indices, and those who can are almost all value investors, like Warren Buffett, who has a track record of 57 years, and many others who have track records of 20 to 30 years. And Buffett learned from his mentor, Ben Graham. And so Li Lu cites the 4 main ideas that students must know, that 3 of which came from Ben Graham, and the last one was added by Buffett, and I'd also venture to guess Charlie Munger. And they include how, 1, we need to think of stocks as fractional ownership of a company. 2, what Mr. Market is. 3, that we need to have a margin of safety. And 4, that has to be within our circle of competence. And I'll get into each of these shortly, in which we need to think of stocks as a fractional ownership of a company or a business that we're considering buying, and not just as a tradable security, because the company grows as GDP grows, and as shareholders, we're supporting this growth. And Li Lu says that this is a sustainable way to invest, and is the right way and main path for investing. And unfortunately, few people understand stocks this way. And number 2, Mr. Market exists as a service provider to offer tradable securities that can be bought and sold freely. So value investors should see the market as existing to serve them in offering opportunities to acquire ownership in companies. But Mr. Market cannot tell you what the true value of a stock is. It can only tell you the current price. So we should treat the market as a tool at our disposal and not as a teacher, unlike what some people believe. And number 3, margin of safety. While the nature of investing is to predict the future, predictions cannot be 100% accurate, so we need to leave a margin for error in our judgment. We should make sure our purchase price is much lower than the intrinsic value of the company. And like Li Lu says, since stock is fractional ownership in the company, as the company is valuable and has intrinsic value, so does its stock. So even if our predictions are wrong, we won't lose as much money, but if we're right, we will be rewarded much more handsomely than others who paid full retail price for the company. Number 4, circle of competence. Adding to the above 3 concepts, Buffett contributed that we should build the circle to give us insights and understanding of industries and companies. The most important idea is to know the boundaries of our circle. If we have an argument for why we should invest in a company, we should also have an argument that disproves the investment case. Mr. Market will expose human weakness and the fallacies of our logic and our lack of understanding, and Mr. Market will then destroy us, and we will be laid bare in the market if our circle of competence has no boundary. So if we invest outside of our circle of competence, the real risk is our ability to permanently lose capital, which has nothing to do with the conventional idea of risk, of the ups and downs of stock prices, aka volatility. I like how Li Lu said that If what you get is what you deserved in others' eyes, your way is sustainable, because he's really big on this idea of deserving the returns that you're getting. And that's also on his website if you see the deserve trust part. And he also goes on to say that value investing allows us to partake in the process of value creation of the continuous growth of a company. And even though the future is full of uncertainties, we diversify this risk by having a margin of safety. On to topic 4. Lilu poses the question of, can value investing become a reality in China as we look out 30 to 50 years? And he talks about how a lot of people see China as special because of how things are done in China compared to the West. And he says that China took many different paths over the last 200 years. And in 1949, it became a centralized planned economy for 30 years. And then in the late 70s and early 80s, it began to embrace Civilization 3.0 of a free market economy plus modern technology and science. And its economic outcomes have been almost identical to other nations that also chose Civilization 3.0. And he shows how the stock market indices of China have returned between 10 to 11% from 1991 through 2014, and this compares to the 7% of returns for the US market. And he also shows how the Chinese currency renminbi has also been losing purchasing power in a similar way as the US dollar has. But because GDP growth has been higher in China, arguably the purchasing power of the Chinese currency has actually been declining at a faster rate. And this makes sense because of how much the Chinese economy is pouring in investment and growing. So we can see that inflation has taken its toll on the value of currency. And not to mention, since the establishment of the stock exchanges and since the early 1990s, the Chinese government has owned stocks from day one, and they've been able to enjoy annualized rates of return of 12% as they own the lion's share of investments. So these state-owned shares have sometimes returned 1,000 times, and that means that the Chinese government is vested in the future success of its stock market. Lilu said that it wasn't so much the culture or economic system or political system that transformed in China, but its civilization that embraced the free market and modern science and technology in its human nature. And he says to understand Civilization 3.0, we need to understand its iron law, and this is also the iron law of modernization, which he says is that it states there are two competing market systems with the interaction of two forces of 1 + 1 is greater than 2 and 1 + 1 is greater than 4. The one with greater trade volume will see greater growth. When one system has greater volume, it will have greater velocity in its growth and eventually create a single system. And this phenomenon is known as the global market system, which has only been around since the early 1990s, as we saw a lot of world events happen around this time, like the Berlin Wall going down. And so this was the origin of being able to participate in a globalized market where a lot of free trade and modern technology and science have been promoted. Lilu believes that value investing can be realized in China because it provides more sustained, stable, safe, and more reliable returns. And he says that value investors have an advantage because the Chinese stock market is still immature, where 70% of the players, including retail investors and institutional investors, are focused on short-term trades. So if we are willing to hold for the long term, we'll have less competitors and a higher probability of success. He said that if we have an understanding of China's people, culture, and history, that China will move forward and it has almost no chance of leaving the common market, and it has a low probability of changing its market rules. And Lilu believes that it's in the midst of an economic transition where it might be around Civilization 2.5 on the path toward Civilization 3.0, because he says that financial reform will open up financial markets so that they don't have to rely as much on indirect bank lending. And so with more market-oriented and institutionalization, that the Chinese markets will become more mature and be better for value investors to be able to participate in. And overall, even though the Chinese government often gets criticized for its heavy-handedness, that ultimately this will be to the benefit of its future markets. One of my biggest takeaways in all this is that given how the government of China has such a large investment stake, that they should have a vested interest in continuing to get as much foreign investment in Chinese companies as possible rather than turning them away in this global marketplace. Li Lu wraps up the lecture by telling the students that they're in the right place at the right time as value investors. And let me know in the comments what you think about these two ethical principles that he reinforces. And they are, first, that you should understand and live up to your fiduciary duty. And second, that you should consider it a moral duty to acquire knowledge and seek wisdom. And if all this jives with you, I'd love if you could please like and subscribe to my video and YouTube channel because I greatly appreciate it. And like Li Lu ends the talk with, I also wish you well on staying the course so that you too can become a stellar investor. Till next time.